The order book as a percentage of total fleet up until February 2022 stands at 6.8%, which is still around the lowest levels we've seen in the last 25 plus years. Whilst Clarksons expects new deliveries of about 3.1% of the current fleet to be delivered in 2022 and 2.6% in 2023, they expect a net fleet growth of around 2% during 2022 and below 1% in 2023, after also taking into account scrapping, slippage, and other possible removals. Consequently, the sector is well positioned for a strong year and structurally for the next several years, thanks to a very limited supply growth. As previously mentioned, global recovery continues, yet new COVID-19 variants, rising energy prices, and elevated inflation still weigh in and may slow economic growth. The market has been on a strong trajectory on the back of highly supportive conditions in the commodity markets, having reached 11-year highs in Q3 2021. In the last quarter, we have seen a significant fall reflecting mostly reduced demand for iron ore from China, which has affected primarily the Capesize market, but has trickled down to the smaller segments as well. We expect earnings to remain volatile at high levels as the short and medium-term outlook are generally positive and supported by one of the lowest order books ever. Seasonal weaknesses can also be expected. Furthermore, ordering of new ships for 2023 deliveries is expected to be extremely low to nearly non-existent due to lack of available slots in shipyards. In addition, as mentioned in previous quarters, the lack of clarity for the fuel of the future remains unknown, something that makes placing a new order a very risky option. Overall, we expect the market to remain at relatively high levels with more stability on the smaller sizes and more volatility in the Capesize sector. Congestion ease timing and the implementation of the new IMO environmental regulations in January 2023 will be key elements in the direction of the market. Over the past year, DryBulk prices have gradually been increasing, exceeding the historical median and average levels, but still are significantly lower than prices seen in the beginning of 2011. We believe that it is highly probable that this period will be a period with higher prices and higher earnings than the last decade, where both earnings and prices, and also inflation, were extremely low, and as such, we are prepared to adapt to this changing environment and continue growing EuroDry steadily but cautiously for the benefit of our shareholders.